Welcome to Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to make a little bit of money here. My job, not just to entertain, though, but to educate. Explain like this, like today can happen. So call me at 1-800-743-CNBC. Tweet me, Jim Cramer. The hairs are split. The heads are counted. The deal is done. The Fed is cut. On to the next story. It really is like that in this business. Only the media seems to know that it's not. And insists on beating the story to a pulp when the ultimate judgment is all that matters. Got a rate cut. Yay! Here's the only cadence you need to know about a Fed meeting. It goes like this. We have a big event coming up. We think the Fed will cut probably a quarter point. Then we get exactly what we want. And the story has been written. If it's a cut, you buy, unless it's the last one. And with this president, surely isn't. If it's a hike, you sell. All but your consistent growth stocks, that is. And that's really all there is to it. Even if that seems like the troglodyte's guide to Fed watching. So with the Fed meeting done and behind us, we can go about our business of buying good stocks that have been kept down while we waited for Jay Powell to take the Fed funds rate down a quarter point. And that's why the average is caught fire after the meeting, with the Dow surging 497 points, S&P jumping 0.67%, NASDAQ advancing 0.33%, and the Russell just going nuts. Now, I know there are lots of questions about the number of dissenters, the real rate of inflation, the exact payroll numbers. There's plenty of hand-wringing about whether inflation is above 3%, because historically it's not a great idea to cut rates when inflation remains high. We hear all this fretting about the red-hot AI business. Is it taking jobs or not taking jobs? We divine the narrative, the not-so-hot rest of the economy. Left out to stock buyers, these things mean nothing if you're going to buy good stocks. They're the questions that reporters have to ask, and Fed Chief Jay Powell feels he has to answer. But they're not particularly significant to you and me. Let me tell you the three things that really do matter. First, the Fed's still on the side of the bulls because it's still in easy mode, even if the current economic data is unclear. That means we don't have to fight the Fed when we buy stocks. Second, with the Fed done for the year, money managers aren't going to fight the tape. Stocks want to go higher. Money has been held back because there was always a chance that the Fed might not give us a rate cut. It'd be a surprise. It could really hurt. That didn't happen, though. So the floodgates are now open, and there's a jailbreak of cash going into the market. Thank you to the late, great Marty Zweig, a whiz of a strategist, who explained the twin concepts of don't fight the Fed and don't fight the tape, and the inverse when you get it. We've got it. Third, when Powell cut short-term rates, long-term rates actually fell. Now, there's only one ultimate judge here of the Fed's actions, and that's the bond market. When the Fed started cutting way back in the fall of last year, the bond market rebelled and long rates went higher, which was very bad for the market. This time, bonds moved in the right direction, which makes Powell and his compadres look like they know what they're doing. Honestly, the bond market was my biggest worry coming into this week in the Fed meeting, but it turned out everything was fine. Sure, maybe it helped that Powell decided to buy short-term Treasury bills, a news story. Maybe he's telling the bond market sellers, hey, listen, think twice because you're going to end up being wrong. In the end, it doesn't matter. Rates went down. That does matter. So, one, the Fed is our friend, not our enemy. Two, the bulls aren't fighting the tape. And three, longer-term rates fell in response to the rate cut. It's a trifecta that allows the stock market to roar. What do you do in this situation? Well, you buy stocks that do better when rates are lower, even a quarter point lower. That means you buy the home builders and you buy the retailers that are connected to the home builders. You go with the ones that we've recently heard from. That means you buy Toll Brothers, which just reported a terrific quarter, but the forecast wasn't as positive. That means, well, the narrative could change, right? Now all they worried about a negative future, well, maybe it's a little more positive. We just heard from Home Depot, and it wasn't as strong as we'd like, again, because interest rates are too high. You still have a chance to buy it here. It's way down, now 100 points below where I think it should be. And the company offered an encouraging scenario if the Fed lowered rates when it gave you that update as at Investor Day yesterday. I'm going to talk about this on our Investor Day for the club on Friday at noon. It's going to be why you can buy a stock like Home Depot. Hey, you know what? You can buy the transports. They thrive when rates go down. I think J.B. Hunt can be bought. The truckers, I never recommend them. But I think the long trucking recession's over. You can buy Federal Express because we're in the holiday season and Raj Subramanian is one great CEO. You can buy Union Pacific and Norfolk Southern because that takeover is a good one. Third, you know what you can do? You can buy the high flyers, the expensive stocks, because people will pay even more for their earnings or just their sales if they don't have earnings. They always do when you get rate cuts. It's just what the hedge fund playbook says you should do. And that's why the Russell 2000 index went up more than all the other indices. That small cap index is full of companies that don't have much in the way of earnings power, but often have rapidly growing sales. Basically, anything that trades on distant prospects many years down the road will do better with lower rates. Now, I'd emphasize going after the ones that are already winning for this year. How about this one? I'm thinking of the stock of Palantir. Even when it's already up so much, it makes a lot of money. It's not a flyer. It just got into the U.S. Navy with a terrific contract helping to build submarines more efficiently and much less expensively. I believe there'll be many more Pentagon contracts coming. Think surface ships, fighter planes, then weapons, munitions. It wouldn't surprise me if the whole arsenal of freedom goes to Palantir. It's precisely the kind of stock that works in this market. The ultimate high flyer that's up huge, that you can buy it right now if you're a money manager and show your investors that you too own Palantir. Finally, you can buy any industrial because the hedge fund playbook says that industrials benefit from lower rates, even if you think it doesn't matter. The fabulous irony of all this, frankly, is that Powell in his own press conference actually came out and said that a quarter point really doesn't mean that much to any industry. I had to laugh at that one. But that's not how hedge funds or even mutual funds think about it. They'll eagerly buy Caterpillar and Cummins, two stocks at their all-time highs, just because they perfectly fit the environment. Now, let's take a step back for a second and think like a portfolio manager when it comes to your own stocks. When you buy stocks, what you want is for the Fed to continue cutting rates. Investors never really like rate hikes, even when the economy needs them, because they're bad for stock prices. And I expect whoever replaces Jay Powell next year will try to keep the cuts coming. That person will be more of an emissary for the president than a let the chips fall where they may empiricist like we have with Powell. Long-term, possibly problematic. Short-term market loves lower rates. We're going to get millions of new stock accounts because of the Trump accounts from the big, beautiful budget bill that are a fabulous handout to newborns. Gets them started young. I like that. New money coming to the market's always refreshing, too, and we have automatic money coming in from these accounts. And you know what? Let's keep it real simple here. We just got a very early Christmas present for Jay Powell. Please do not look a gift horse in the mouth. The bottom line, just make sure you don't get bearish when the time is right to be bullish going into the end of the year. And bears who are grumpy and unhappy, I expect you to come on our TV, our network, and many others and tell us that the buyers are wrong, that I'm wrong, and even as the buyers are making money, and you may be losing fortunes, well, you want to tell us how right you are. Well, that's the plight of a bear in what seems to be a never-ending bull market. What can I say? Can't please everybody. Jeff in New Jersey. Jeff.
Hi, Jim. Jeff from Central Jersey, a.k.a. Dr. ECE. You had a really monster fish I saw. I'm calling about Visa. My concern is that more and more places are charging credit card fees, 3-4%, and you're getting back 1%. The math doesn't add up. Will they lose transactions?
No, I just had a nice, really nice update with Visa just the other day. And it was really quite amazing. They're doing incredibly well. Look, if you want to get into the business of credit cards that don't charge as much, I want you to go buy the stock in Capital One, which has been one of my big recommendations for this year. The club members know I think it's terrific. We're going to talk about it again on Friday. It did hit a new high today, but that doesn't mean anything because it sells at 12 times earnings. COF, Capital One. You know the ads? It should be in your portfolio, not just your wallet. The bears are welcome to come on TV and tell us why the buyers who are making all the money are wrong, because that's what these people know to do. But remember, the buyers are the ones who are winning on Mad Money Today. If you want to know how the consumer is faring, why not check in with their furry friends? I'm hearing all about the state of pet spending with the CEO of Chewy, a stock I like very much. Then, where do things stand with Deere after its positive investor day? I'm plowing through the numbers and showing you where I come down. A year ago, Service Titan came public on Trades Day. Now I'm getting a chance to sit down with the CEO, whom I've always wanted to, and get a closer look at this company that is well off its high and might be an opportunity. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Well, here's a confusing one. This morning, we got this set of numbers from Chewy, the online store for pet food and pet supplies that I have told you I like very much. Company reported a modest top and bottom line beat, also raising the low end of their full year forecast. At the same time, though, the guidance for the current quarter seemed to be a little light. Wall Street seemed to have a hard time figuring out what to make of these results. Stock initially dropped in pre-market trading, then it came roaring back. It opened almost up 7%. Then immediately pulled back from its high, spending the rest of the day fluctuating between positive and negative territory, with the stock only finishing up 1.5%. It was just crazy. So what comes next? Let's check in with Sumit Singh. He's the CEO of Chewy. Get a better read of the quarter, where it's going. Mr. Singh, welcome back to Mad Money.
Nice to be here, Jim. Thank you for having me.
Okay, so first, 2 years ago, you told us the stock was done going down. It was around $20. That was dead right. It's actually never looked back. I looked at this set of numbers. I didn't find them confusing. You're going about exactly what you said. You're continuing to dominate. You're taking share. You're on plan. Am I right that there was really nothing all that confusing about it?
Yeah, that's exactly right, Jim. We are really proud of the way that the team is executing. So, we grew revenue at 8%. That is more than 2 times the rate of industry growth in 2025. And profits grew, 30%. So 3 times the revenue growth. Free cash flow continues to accumulate, and we're looking forward to having a great year end.
And I think that's important. When I went out very positive and ever since been positive, all I ever hear about is, well, Jim, do you understand that Petco's got something like that? Do you understand that Amazon's got something like that? Do you understand that Walmart's got something like that? From what I can tell, you're beating all those guys.
Yeah, Jim, pets, as you and I have always appreciated, is a super emotive category. And in an emotive category like this, when you show up with being best in class in what we do, which is e-commerce, but then we deliver service levels that you can only expect at, the best local neighborhood pet stores, it kind of is the best of 2 worlds. It's the combination of scale and convenience of e-commerce and the personalization, on top of that. So, we have a very durable set of mechanisms. AutoShip. You and I, talked about AutoShip in 2019, and it was at 60% levels. We are now pushing over 84% of our sales through this quasi-subscription program. And since then, we've built a health ecosystem that continues to pull more customers, drive greater retention, and drive us towards premium growth and profitability. So overall, I feel like we've got a pretty good, durable, and differentiated set of levers.
All right, I totally agree. Now, there was this kind of let's go over what the next quarter really meant. I felt what you said you're going to spend in order to be able to prudently grow. Other people were saying they have to spend because they have to spend, or that they're spending out of defense. But again, this is one where you have taught us, look, we have to spend. We want to continue to grow. And there's really nothing more than that.
Yeah, I think there's a couple messages that should be heard very, very loudly. One, we are growing, we're aggregating share across the industry, growing at more than 2 times the market. Number 2, Chewy does not require investment to continue to deliver, growing levels of top line. And then 3, it's not top line or bottom line for us, it's both. We are simultaneously delivering top-line expansion at the same time we're growing our margins. I mean, we delivered 100 basis points or 30% in profit growth in Q3. And for the year, we're going to deliver north of 25% profit growth while converting 80% of those profits into free cash flow.
All right, well, that's exactly what I want. Tell me a little bit more about Chewy Plus. Seems that we saw you right when you were about to launch it. It's so far so good?
We're loving Chewy Plus. So it's a program that is meant to give customers a chance to really get to know all of the offerings of Chewy in a very simple manner. It aggregates share of wallet very quickly for us, and it is really primed, to help us consolidate basket sizes and drive customer satisfaction and value back to consumers while consolidating share of wallet towards us. And so, early days, we've been at it for about 6 months. And we like the results so far. You
have always moved into the agencies that I've most wanted you to move into, which is, of course, veterinary. And veterinary seems to be working out better than we thought.
It really is. We have a pretty unique proposition. It's a model that is built on the core pillars of high-touch customer centricity. B, we have very high customer satisfaction scores. And then 3, we're really using sort of empathy and technology together to deliver experiences. So here's what we're observing. 4 out of 10 customers that are walking into our locations are net new to Chewy, right? In a very short amount of time, half the customers that are walking in are then attaching other categories like pharmacy or health and wellness supplements from Chewy.com. So not only are we aggregating share of wallet quickly, we're also seeing net customer incrementality and brand scores continuing to lift up, whichever market we're launching CVC in.
Now,
so we're quite excited about it.
Right. One thing I've not seen it myself. I mean, when are we going to see them in Brooklyn, for instance, or New Jersey, where I spend some time in both?
Yeah, we'd welcome you in any of the locations we have them currently. So currently we've got them in 4 states: Florida, Atlanta, Denver, and Texas, or Colorado and Texas. And what you should expect from us as we move, we've actually just launched one in Phoenix last week, so we're now in Arizona as well. You should expect us to densify our footprint as we move into next year. What that does is it gives us really good leverage from an OpEx point of view, gives us marketing benefits from an in-ground, awareness point of view, and allows us really good cross-training opportunities for our staff. So, look for these to continue to densify, and we welcome you in any of these locations.
Thank you very much. I hope I don't have to use you, but that's good news. Now, how about Get Real? How are we doing with the fresh food offering?
Fresh and frozen, I would categorize this as the new format that continues to support this trend of humanization and premiumization that we've talked about for so long. And so we see this as a market that, is going to be in the billions over the next few years. And, we felt that Chewy has a right to participate, and we're doing so by bringing forward, a private label product called Get Real. Customer reception has been great. More so than that, dog reception has been great, and the humans are loving it as well.
All right.
NPS scores are great. Product ratings are good. We're excited about what's to come.
Finally, consumers spending more or less on their pets this year?
Consumer spending, well, on our platform, consumer spending's up. As you can tell, we're aggregating NSPAC, growing it at 5%, levels, in addition to picking up an incremental 5% customers from the market, which is the composition of our revenue growth. So consumers, continue to spend on consumables and health. They're still a little bit weary of discretionary, but at Chewy, we grew discretionary at 18% year over year. So we're happy about those results.
Well, that's all I need to know. Another good quarter. I'm not confused about it at all. That's Sumit Singh, CEO of Chewy. Sumit, it's great that you called the bottom when you were on a couple of years ago. And to me, I don't see a top. So congratulations.
Thank you. Really appreciate it.
Very good. Man, I'm going to be back after the break.
Coming up, with Deere's Investor Day in the rear view, is it time to jump back on board with the machinery maker? Cramer makes the case to buy into a bounce back. Next.
Earlier this week, President Trump rolled out a $12 billion aid package for American farmers, in part to ease the pain that they're feeling from the trade war. And when farmers get money, you know what they do? They tend to buy agricultural equipment. So could this be the moment that Deere finally comes back in style on the Wall Street fashion show? It's been a while. Here's a stock that I mistakenly recommended in June when it was trading at $508. See, I assumed it could keep running as the fundamentals of the underlying business continued to improve. Do you know what? The fundamentals did get better, but the stock spent the last 7 months drifting lower to almost $469 as of today. I was quite surprised. The frustrating thing about Deere is that I was right about the company. It's just that Wall Street hasn't had any appetite for the stock. It does happen. They do diverge. When Deere reported in August, for example, it delivered a pretty solid earnings beat and raised its full-year net income forecast. I thought that was going to be terrific. Then just a couple of weeks ago, they reported a healthy top and bottom line beat. I thought that would mean something. The big story from that quarter, or at least what should have been the big story, was the fact that for the first time in 9 quarters, Deere had positive net sales growth, up 14%. Sadly, that wasn't the main story from the quarter, though. Instead, Wall Street focused on management's seemingly disappointing forecast for 2026. The most important number that Deere guides for is net income, and management said that they're expecting $4 to $4.75 billion in net income for 2026. Well below the $5.11 billion that the analysts were looking for. That was disappointing. At the same time, Deere said its production precision ag segment would be down 5 to 10% for the year, which is brutal. because that's 45% of the business. And that's why the stock tumbled nearly 6% on the day of the report, even though the numbers themselves were excellent. On Monday, though, Deere hosted this Investor Day event right here at the New York Stock Exchange, where they had some encouraging things to say, although, again, the markets didn't seem to take notice. Management started by highlighting the changes that they've made to their operating model. First, Deere said that it's restructured its business to focus on customers' distinct production systems. Basically, they reorganized it into 10 units focused on their 10 main end markets, from sugarcane to road building. I was thrilled about the granularity here. Next, Deere centralized its technology stack, which will help them deploy cutting-edge solutions across all of their end markets. I've always liked this company's commitment to innovation. It's pretty big. On the tech front, Deere offered a roadmap to fully automated production systems by 2030. Also spent some time highlighting some new retrofit kits that will help previous generations of tractors become autonomous retroactively. They highlighted a bunch of other stuff like cameras that identify weeds and then spray weed killer only where it's needed, or it's something called Exact Shot, which is a more targeted way to apply starter fertilizer instead of spreading it across the whole farm. That can add up to big cost savings for farmers. Finally, Deere basically said that they've been leaning into services, keeping their machinery running longer, making it more useful. That's terrific, because this type of business represents more dependable recurring revenue that helps smooth out the company's numbers. More importantly, though, Deere rolled out some new long-term financial forecasts that I thought were very, very bullish. Management said they expect net sales to rise at a 10% compound annual growth rate from this year through 2030. Very strong. For perspective, from 2000 to 2009, Deere's revenue compounded at just a 7% clip. From 2010 to 2019, it was more like a 5% clip. From 2020 to 2025, it was just a 4% clip. In other words, management predicting that they'll be able to deliver their best long-term revenue growth in a couple of decades over the next 5 years. I think that's huge. If you believe they can hit the number, then Deere's going from a 4% grower to a 10% grower, and typically Wall Street's willing to pay a lot more for stocks with faster revenue growth. Yet for some reason, again, the stock didn't rally. Man, this thing is hated. It actually went lower. Why? Because we're only a few weeks away from the end of the year, and this is when money managers tend to buy winners, not stocks that have been languishing for 7 months like Deere. I do believe Deere can hit its targets, though, and sooner or later that's going to matter. Management says they can turbocharge their growth rate through product leadership, more recurring revenue from the services business, as well as software sales and inorganic growth, meaning acquisitions. Apart from that, Deere said that it expects mid-cycle profit margins in the 20% range. Wasn't exactly new, but it was good to hear it reiterated. In the previous ag up cycle, Deere's operating margins peaked at about 18% in 2023, and it was more like 10% last year. So I'm certainly not complaining about a trip back to 20% the next couple of years. Now, how about that farm subsidy package the president announced on Monday? Okay, everybody immediately picked sides on this issue because we're really in a bitterly divided nation. I don't really have a problem with bailing out industries that got caught in the crossfire of the trade war, although I got to say it's kind of crazy that we live in a world now where so many people have strong opinions about industrial policy. But for our purposes, look, it doesn't matter why this is happening. It only matters that U.S. farmers are Deere's primary customer base, and that industry is about to get $12 billion from the federal government. Sure, we'd love it to be from crops going up, but you got to take it where you can get it here. You better believe a decent chunk of this bail is going to tractors and other kinds of ag equipment. So let me give you the bottom line on what's a very simple, clean story. Deere stock has spent most of the past 7 months cooling off after a big run in late 2024 and early 2025. But I think the stock's ready to start running again. If not now, then soon. This is a high-quality company that's finally returned to strong revenue growth after a couple years lost in the wilderness, and management sounds very confident about the future through 2030. So if you don't own any Deere already, or if you bought some when I said it and you probably want to buy some more down here, I got to tell you, you're right. I feel like you're getting a great opportunity to buy some shares in a really high-quality industrial when all the others are flying, while Wall Street's still ignoring this one. I think most likely at its own peril. Let's take calls. Let's go to Baruch in California. Baruch.
Hey, Jim. I hope everything is going well.
It is going very well. How about you?
Thank God, good. I wanted to talk to you about Decker's outdoor stock, specifically because the stock was doing quite well towards late summer, reaching as high as 123.91. Then it began like a precipitous decline to 79.54 once Decker's guidance indicated that tariffs not only eat into profits but also decrease consumer spending. And so, at least lately, Decker's share price seems to have entered a resurgence. And I was curious, given the U.S. tariff deal with China, whether you think the resurgence is sustainable and it's worth sticking with Decker's given its past volatility. And also, could Decker's reflect the general trend within consumer retail recently?
Okay, I'm going to take the other side of the trade here and say that I think that the company's momentum is still not that good. And I would think that if you want a company that I think is on the upswing, I would rather see you in Nike. You can buy some here at 65. And then if it drops down to, say, 60, because it could happen when they report in December 18, you buy more and then just let that run, because that's going to be the one that I think is, for the next 5 years, the best in show. Elliott Hill's doing a good job. Let's go to Roy in North Carolina. Roy.
Yes, sir.
Roy, you're up. It's Jim. What's happening?
Appreciate you taking my call.
No problem.
Wondering what's going on with Procter & Gamble. March, it was
right.
up in the high 70s. Now it's down in the 40s.
I'm very glad you asked about Procter & Gamble. Okay, so they disappointed the street. I'm going to spend a lot of my time on my Friday conference call with Jeff Marks on the Investing Club, talking about why you should buy Procter & Gamble and how you're going to make a lot of money doing so, but you must have patience. Patience is going to pay off with PG. Thank you, and I'll see you Friday at our noon monthly conference call. All right, Deere stock has spent the past few months cooling off, but I think it's ready to run again. I don't think AGCO would disagree with that either, by the way. Much more Mad Money ahead, including my exclusive with the CEO of a platform bringing the trades into the AI era. It's called Service Titan, first time on the show. Then, could the year of magical investing claw its way back into the zeitgeist? I'm giving you my take on a day when the Fed just gave us a break and outlining where your spec stocks stand right now. Rapid fire also, of course, in tonight's edition of the Lightning Round. So stay with Cramer. Last week, we got earnings from a company called Service Titan. It's a software provider to all sorts of tradespeople, especially the building trades. This is a company that came public roughly a year ago. It was trading around $100 a share. At that time, I told you that I liked the story, but I thought you should wait for a pullback before you did any buying. Sure enough, Service Titan pulled back to around $80 in March before surging to $131 and change at its peak in May, then pulling back to the mid-80s again about 3 weeks ago. But since those lows, the stock has rallied more than $20. Doesn't hurt that Service Titan reported last week it delivered a healthy revenue beat with a better-than-expected operating income number, and that breathed new life into the stock as it should. So can it keep running? Let's take a closer look with Ara Modesian. He's the co-founder, chair, and CEO of Service Titan to find out. Mr. Modesian, welcome to Mad Money.
Mr. Cramer, thank you so much. I think given your extraordinary roster of past guests, it is very deeply humbling, and I'm very grateful to be here.
Well, you're very kind to say that. I feel I'm in the presence of someone who has invented an industry that is so sorely needed that I will return the compliment. I do want our viewers, though, to know I've been following you for when Goldman first tapped you guys. I said, these guys have a model no one else has. If you could share that with our viewers so they know exactly how, as we said at law school, sui generis, unlike any other company, your business is.
Thank you. Service Titan it's the operating system that powers the trade. So if you think of your local plumbing, air conditioning, or electrical services contracting business, these are our customers, and our software is the all-in-one solution that they use to manage every part of their business. And so typically this industry doesn't really rank very highly on the glamour scale, but you can imagine it does on the criticality scale. These are very hardworking men and women that keep the world running where you live, where you work. You need access to power, water, air. And these are often the heroes who fly across town and save the day when something goes wrong, either in our homes or in our commercial properties. And we've seen that they've just been very underserved for quite some time. And Service Titan is bringing that power of Silicon Valley to Main Street to give them the same tools that others have access to, and hopefully the success that they deserve as well.
Well, all right, I've got to tell you, my feeling about tradespeople is it's always such a shame they leave me a paper bill, because that's what they do. It's on my desk because they trust me, thank heavens. I want to get a hold of them to tell them, listen, you can just give me a wire instruction, but you can't because they're out on the job. They don't have anyone answering the phone because they're solo practitioners, or they work with a few, as they would be your client. You put an end to this for the ones that have a few business, a couple of trucks and trying to do a good job. It's no longer like that if you're a Service Titan client.
That's right. I think you described it incredibly well. Ultimately, what the software does for them is it helps them deliver a much better customer experience. And when they do that, they often find that they see very significant increases in revenue and ultimately profitability. And it's not uncommon to see our customers double, triple, 5x, 10x their business within a few years of using ServiceTitan. And these are transformational outcomes, not just for their businesses, but of course, they can often be life-changing for folks as well. It's like, in many cases, it's the first time they're able to step away from work and take a vacation, or just to leave work a little bit early to make it to the kids' soccer match. And as you said, it does it by managing every aspect of their business, from how they do their marketing to how they handle phone calls, to how they book the appointments, schedule and dispatch all the technicians to go to the hundreds of homes they need to service in their communities, manages their inventory, payroll, and frankly, everything else.
Well, I think that I want to go a little bit deeper on something you said, which is that they went to their kids' game, so to speak. My feeling is always that if there isn't someone picking up the phone, or if it just rings and rings, I'm going to go to the next one. But with Agentics, rather than just, there's so many people come on here and they claim, well, listen, Agentics did this, we replaced the person with this, that. These people have no one to replace. It's just themselves. It's just their small group of people. So tell us what it's like. I call up my plumber. He's part of a group. It rings and rings. That's the current thing, and nothing happens. What happens if I call a plumber who's part of your system?
That's right, Mr. Cramer. Well, we service contractors of all shapes and sizes. So we certainly have family-owned businesses. We have private equity-backed businesses. We have smaller businesses. We have very large businesses that we serve. But all of them struggle with the same challenges. They are overloaded with work. There's a lot of demand for their services. And the challenge is that there may be a sudden surge in demand, right? If water pipes start to freeze in Texas, you're going to have 2x, 5x, 10x the call volume, and you can't necessarily scale headcount very quickly to handle it. Or if you're a plumbing company with 20 technicians on the road serving 100 homes today, and all of a sudden you get 5 emergency jobs booked that you got to get technicians out there in 5 minutes. You can't all of a sudden play Tetris on your dispatch board to rearrange all the jobs to get everyone serviced. And so, it might be a little bit counterintuitive that one of the most traditional industries actually has the largest opportunity for AI. But for example, our Dispatch Pro product is an AI product that'll automatically figure out what is the best technician to get to which either home or commercial property. And if changes happen, it'll do the Tetris automatically in real time. Or if there's a sudden surge in call volume, our voice agents will handle the overflow that the customer service reps can't get to, and it'll make sure we book those appointments so that someone can get out there and resolve the issue.
So a company that joins your universe can find other things that apparently, from what I've read, give you an even better return on investment than just the plain old lower tier. Talk to us about the higher tiers.
Certainly. We have this concept of the core product. The core product provides, call it a medium level of capability across every key workflow in a contracting business, from helping them market better to generate more customers, to book calls better, to dispatch better, diagnose problems in the field better, manage inventory and payroll better. And typically customers will first sign up with our core product to elevate their business across all these workflows. And then once they see a high level of return on this core product, we will then earn their trust and partnership and the desire to upgrade to our pro products, which are the highest level of capability and sophistication. Marketing Pro for the most advanced marketing, Dispatch Pro for the most sophisticated dispatching, and so on and so forth.
Now, the last thing I want to ask you, one of the things that I think a lot of people are very concerned about is the industry's aging out. There are not a lot of people wanting to go in these businesses, even though they're very, very good businesses. And as people get older who may be ServiceTitan customers and they retire, what happens? I mean, do you have an attrition problem just because we just don't have enough tradespeople and not enough people are attracted to it?
That is certainly the case, Mr. Cramer. There's generally a shortage of labor, but increasingly what we are seeing is that the next generation is seeing the skilled trades as a fantastic place to build an incredible career. We now have folks coming straight out of high school, which are the most junior technicians, who in some cases immediately, in some cases within a few years, are able to earn 6-figure paychecks by doing incredible work in a residential home or in a commercial property. And I think the most exciting part of the skilled trades is that it is potentially the most future-proof industry. Just recently I asked ChatGPT which jobs are least likely to be disrupted by AI, and it literally told me plumbing, HVAC, roofing, and so forth. And I think if we refer to all the studies that have been done on AI, for example, the recent one from Microsoft, they describe it as the jobs and industries that are purely cognitive are the ones that are at greatest risk of disruption from AI. And you see even things like legal, medical, computer science at risk of disruption. And then the jobs where they're, of course, cognitive, but also require incredible physical dexterity in unpredictable environments. Think of having to crawl into an attic or a crawl space to diagnose a problem and fix it, or climb on top of a roof to do the same thing. These are the ones that are least likely to get disrupted by AI.
Well, look, I think you're in a great spot. You've got it all by yourself. You've done a terrific job. I've been following your career for a very long time. Congratulations to all of the goodness that you have done for your shareholders and for your, I've got to tell you, this was a great quarter. And let's leave it at that. Darren Modestian, he's the co-founder, chair, and CEO of ServiceTitan. Thank you for coming on. I really appreciate it.
Thank you, sir. Sincerely, I know you usually feature great luminaries, so the fact that you let me sneak in, I greatly appreciate it.
Well, I think you've done
so
a lot of great things yourself. Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It's time for the lightning round. Same the stock that about buy, sell, I don't know the close. Save the about stamp prepares the graphics the way you play the sound. And then the lightning round is over. Are you ready? Ski that's on the lightning round. Let's start with Jim in Connecticut. Jim,
you added Boeing to your trust. Hexel makes lightweight material for Boeing and many other companies.
Hexcel's a very good company, sir. The only reason I said to buy Boeing is both Hexcel and Howmet had gone up too high. Boeing is still lagging. Let's go to Steve in Pennsylvania. Steve.
Yeah, Jim. Steve from Philly. Booyah. Go
Booyah.
Birds.
How you doing, partner? Go Birds, we hope. What's happening?
Yeah. Not too much. Listen, Jim, long-time listener, read all your books. Absolutely love everything that you've done for us as investors. So thanks so much for that.
You're quite welcome.
I'm calling about SoundHound today. SOUN?
No, see, SoundHound doesn't make any money. It's one of those year of magical investing stocks, and that year is over. Let's go to Hunter in Texas. Hunter.
Jim, big fan. Me and the boys over here, we're always looking for the next big play. Right now we're looking at ROOT.
No, you got to keep looking at something else. It's not going to do it for you. It's actually an expensive stock, even though it doesn't look like it. Because I don't think all the earnings are going to come through. But you know what? You got to think about lemonade. I'm not kidding. Let's go to Jim in Florida. Jim.
Jimmy Chill, a bit warm, sunny Naples, Florida. Booyah to you.
That's a very spirited booyah. What's going on?
My question's on a stock that's down 38% year to date. I decided earlier in the week to tax loss harvest the thing. Do I wait the 31 days and buy it back? It's just ticker symbol is Dow. Buy, sell, or hold.
No, I'll tell you why. It had a nice bounce off of the cut. It could have another point or two, but that's all. I don't want you to play for just a point or two. I want you to play for the enchilada. Let's go to Jay in New Jersey. Jay.
Hey, Cramer. How you doing?
I'm doing well. How about you?
I'm good. I just had a question about Carvana. Just wanted to know what your thoughts on it.
Here's the answer about Carvana. The stock is going higher. Now, it may not just continue to go higher because it just had a huge run. But I have been behind this stock since it was a teenager, and I'm continuing to do so. I think Ernie Garcia has a better model than anybody else. Let's go to Doug in Maryland. Doug.
Hi, Jim. Love the new book.
Oh, thank you, Doug. Thank you.
I want to thank you for helping me and my 5 boys in our investing journey. My question is, with the huge data center power demand, what do you think about the global power generation company AES Corporation?
It's always been disliked. And you know what? I've taken a liking to it down here. I think you've got a buying opportunity in AES. And thank you for the kind words. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, if the year of magical investing has ended, where should you turn in 2026? Cramer breaks down the importance of real revenue. Next.
Will the year of magical investing come back now that the Fed has cut rates? I don't think so. When I went negative on the high flyers, the neo-cloud stocks, the ambiguous artificial intelligence plays, the nukes, the crypto derivatives, the quantum computing stocks, and the flying car names, I warned that people were about to get crushed in this stuff. This morning I was walking the street. Carl asked me whether these stocks could now roar into the close of the year. I said no chance, especially the faux data center stocks after an earnings miss from data center builder Oracle after the close. Let's go back to when I went negative on these super speculative stocks on September 24th of this year. I based that call on a peculiar condition, the outrageous number of speculative stocks that you've given me in the lightning round a couple of days before. The so-called year of magical investing had gone parabolic, and I was worried that people would begin to lose fortunes if they stuck around. Both research director Ben Stoto and I knew we had become too permissive. It was time to shut the door on these particular high flyers. As is often the case, many of these stocks kept going higher for a week or two. Looked bad for a second there. But then almost all of them peaked and says, and you know what? It has been absolutely horrendous.
The House of Pain.
Most of them have been cut in half or worse. Nano Nuclear Energy, a formerly red-hot nuclear stock. Aramco Resources, a coal miner turned rare earth minerals play. Rigetti and quantum computing. Red Cat and drones. They've been eviscerated. Those aren't even the worst performers. They're simply representative of what's going on. The call hurt when we made it. We got a lot of negative feedback, but in the end, it was right. Some of the worst hit have been the recent IPOs, often because they went ridiculously high after they came public, powered by the overenthusiasm of traders. It wasn't the fault of the bankers that something like Figma, the visual design software company, climbed from $33 where it was priced to $142 and changed at the peak. Now it's at $39, almost a round trip. While the speculative plays have gotten crushed, we've seen a powerful rally in real stocks of real companies with real sales and real earnings. I like that. What happened here with the now fallen specs? I think people didn't know what they owned. They didn't know how to value these stocks because they were playing the greater fool theory, buying something hot and then hoping someone else would take them out of their position at higher prices. I talk about how this happens and how to make money in any market. When this kind of speculative mania occurs, it's important for people who've lived through other manias to call them out. These bubbles are a big reason why individual investors often underperform the S&P 500. If people simply took profits on the way up, they'd do fine. That's really the case. Investors become true believers in the stocks of companies that they don't even know. They aren't worried that the FAA hates flying cars. They don't care that it takes a decade to build a new nuke plant. It means nothing to them that only IBM and Google offer commercial quantum computing. And it isn't much, or that many of the Bitcoin derivatives like Strategy, formerly MicroStrategy, have been annihilated. Now, there's a way to speculate responsibly. You buy stocks of companies with real earnings, real revenues, that can get a much higher price to earnings multiple expansion on that news flow. It's not the perfect way, but it's a way. GE Vernova soared during this period as it got order after order from companies that needed power to build out data centers. It closed today at $723. That was up $97. One session. Palantir continued to surge higher as it won tons of contracts, both from the private sector and the federal government. It went up $6 today to $188. Neither stock is done going higher. These kinds of stocks with the ability to turn into high-powered, high-earning stories could absolutely last through the end of the year of magical investing because their sales and earnings are still growing like weeds. But the others, they aren't worthy of your money or your time, even down here, because the year of magical investing came to a close at the end of September, and it's not coming back anytime soon. I say, I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.